What is it going to take for the stock market to keep going up? Well, my answer to that question is the same three things it has always taken for the stock market to go up: an alignment of earnings, events, and emotions. First, earnings. Nothing happens in capitalism until somebody makes a profit. The good news is that this happens most of the time. Since World War II, the profits of corporate America have grown at a fairly steady clip of around 6% annually, according to Standard & Poor's. If that were the only determinant, then we would have a stock market that would grow at exactly 6% per year, and that would be that. But as anyone knows, that's hardly what happens. The other two elements of the stock market growth explain why earnings are never enough. So the second element is events. Stuff happens. Wars are fought. Terrorists attack. Nations default on their debt. Consumers borrow too much money. Hurricanes hit population centers. Political regimes are overturned. An oversized generation retires. For the most part, events are short-term in nature and in effect. Markets may move dramatically when a terrorist crashes a plane into a building, but markets quickly regain their equilibrium. The reason most events do not have a long-lasting impact is because they don't significantly affect the corporate world's ability to make a profit. No impact to earnings, no long-term effect. Other effects, however, are not so short-term in their impact. Events like the financial crisis of 2007, the European debt crisis, the United States government's growing unfunded liability from Social Security and Medicare, these can all affect the long-term viability of corporate earnings directly or indirectly. The markets know this and don't overlook such events quite so sanguinely. Well, the third is emotions. Human beings evaluate both earnings and events through a filter called emotions. Our human emotions process the facts of earnings and events and attach to them a magnification factor that is somewhere up or down the optimism or pessimism scale. In the late 1990s, we human investors in the American stock market had experienced nearly 20 years of growing profits and upward market movement. Such factors can become self-fulfilling prophecies. In 1980, investors felt pessimistic about the future and would only pay about 10 times the earnings of the average stock. So if a company earned, say, $5 a share, then investors were willing, due to their emotional evaluation of the future, to pay $50 a share for the company's stock. 19 years later, in 1999, the same company earning $5 a share might command $150 a share, or 30 times earnings. It got so frothy that stocks of technology companies were selling for hundreds of dollars per share while earning zero. We were that optimistic, some would say delusional, about the future. Well, such earnings multiple expansion is always a function of growing or shrinking optimism about the future. In short, emotions. So will earnings, events, and emotions all converge to see the stock market continue its march onward and upward? Well, soon as I get the word, I will pass it on to you. Offering wisdom on wealth, I'm Byron Moore.